Welcome to another episode of Elixir Talks, where we discuss information which simplifies real estate and enables you to achieve your goals better. In this episode, we will try to understand what is home equity line of credit and how we can utilize it for our benefit in real estate investments. We will also take a sample scenario to understand how exactly it is calculated. A secured line of credit is essentially a low interest loan that a financial institution offers you against your investments as a collateral, generally your own real estate property or guaranteed investment certificates, etc. Since your owned assets backs the line of credit, it has a relatively lower interest rate and higher credit limit. The lender has a safety net that they can acquire and freeze the asset if the borrower does not pay the debt on agreed terms. They can go for power of sale of the property to recover their funds. The terms are generally better on secured lines of credit than unsecured ones by much lower interest rates, and the payments can be interest only payments. This re-advancing or refinancing of funds backed by real estate or GIC type of security is also called the equity line of credit, or sometimes HELOC, home equity line of credit. The lenders would assess how much can be provided to you as a secured line of credit by evaluation of the following: your credit worthiness. This is primary for a lender to see if credit rating is not fractured and you indeed have a good loan repayment history. Your equity. How much of your own equity do you have in the asset you are trying to utilize as collateral in getting the secured line of credit? You should have at least 20% equity in your home. Source of income. This is another essential factor to know whether you would be able to survive the interest payments if you decide to utilize the funds in a secured line of credit by considering your existing liabilities like mortgage, car loans, personal loans, etc. Property appraisal. Process to ascertain the market valuation of the property which is backed as the security for the line of credit. These factors would determine how large or small HELOC a financial institution will offer you. Now let us try to also understand some benefits of secured line of credit. The first and foremost is flexible access to funds. You can utilize the amount of approved funds as and when you require it. It is immediately accessible, and interest only applies to the portion utilized by you. Interest only payments. You can only pay interest to ensure your monthly cash flow is controlled. You can pay back any time without any penalty charges. It is a revolving credit. When you pay back the borrowed funds, the amount of remaining credit increases to the maximum amount of line which was approved. Payment could be only on the interest on the amount you borrowed as a minimum monthly payment. You can pay back the principal amount borrowed in one shot or part payments as you desire. HELOCs are generally utilized for making larger purchases and home renovations due to their lower costs in terms of moderate interest rates and repayment terms. Now the final question remains, how much HELOC I can get? There are two considerations for the determination of this amount. The home equity line of credit funds cannot exceed 65% of the home's value in order to safeguard the lender. Also, your mortgage loan balance plus your approved line of credit cannot be more than 80% of home value. Let us understand this and make it clear with an example. Let us assume the market valuation of a home is 800,000. 65% of the market value comes to 520,000. In scenario 1, your outstanding loan balance is 325,000. Maximum loan to value based on 80% is 640,000. Outstanding balance on the current mortgage is 325,000. Allowable HELOC amount will be maximum loan to value amount minus the outstanding balance. In our case, it is 315,000. To ensure how much HELOC amount is to value, it is 39% in our case, which is less than 65% of the market value of the line. Here in our example, 65% of the market value is 520,000. So our HELOC cannot exceed this value. And in our case, it is 315,000, which is well within. Now let's go to scenario number 2. Maximum loan to value based on 80% is 640,000. Outstanding balance on the current mortgage, let's assume it is 25,000. Allowable HELOC amount will be maximum loan to value amount minus the outstanding balance. It comes to 615,000. However, 615,000 is higher than 520,000. So here maximum allowable HELOC amount will be 520,000. Another important thing you should remember is that for HELOC, various banks have different minimum amount requirements, which you can take as a secured line. The maximum loan amount theoretically can be 65% of the market value. Hope it was helpful, and thanks for watching. And if you like this episode, do subscribe for more such content and share with your friends who might be looking into getting a home equity line of credit. Stay positive, and I will see you soon.